welcome back. This is our midweek review for the ICT mentorship. It's going to be a brief one. Usually I say that and it turns into a marathon. All right, so hopefully everyone's doing well. I am going to cover obviously the dollar index, euro dollar, and cable. And I want to kind of like remind you all that there is typically only a midweek review and a weekend commentary video, plus your lessons that you get each month. And I've had mixed reviews. It's kind of like 50-50. Some of you really like the PDF files. Others hate them. The good parts, obviously, are those individuals can print them out and add their own annotations to what I already have. The bad part is there isn't any commentary that kind of like tells you what you're supposed to be doing every single day, which was never really promised to you when you first enrolled. But I said that we would be doing these until around June. And then these PDF files will start becoming daily lessons where I don't need a video to teach. Okay. Some of you are forgetting the importance of why I'm even submitting to you these daily log entries. They're not meant for you to hear me say, look up here, buy here, and try to get out there. With experience, you'll see that that's what they can communicate, but without me having to say it. If you've been studying them, you can see there's been significant turning points and targets reached based on the things that I'm sharing. Now, some of you, especially the new folks, are almost trying to twist my arm and saying, I really don't like these ICT. I really like the videos where you said this is what's going to happen and that's what's going to happen. Which is also why I wanted to wean you off of that, because it's not been promised, and two, it creates codependency. The price action logs, they are geared towards kind of like encouraging you to be more trustworthy as an analyst. Now, obviously, that doesn't mean that you're going to be right all the time, and that's what you're afraid of. You don't want to go through those uncomfortable periods when that's where your real learning is going to come. So try not to have the mindset that you need me every single day pointing out things, because the commentaries I'm giving you, I'm telling you what to look for. And today I'm going to kind of like remind you of that with the teaching. So use the daily log entries as a guide to see what you're noticing in the charts. Now, obviously, you're probably going to have a whole lot more in your charts, but I'm pulling out the most important things right now to me and with my experience. You, because you have low experience, and that's not a bad thing. It's just the facts. You're just starting. So you're not going to see the things that I see 100% of the time. Some of you will, but not all of you. That just is a testimony to your infancy in learning here. That's all it is. It's not a scorecard for passing or failing. It's a way for you to measure each day what you're supposed to be focusing on, what's most salient right now. And it trains you to see these things. See, most of you, and again, I'm only really speaking primarily to the new group, you're trying to skip ahead because you want it right now, and your impatience is forcing you to have impulsive behavior. So much so that you're sending me emails saying, I don't like this, when that's not going to change what I'm doing. Okay, that's not going to have any bearing on how I'm going to deliver the content. Others have sent me emails saying, I feel like you're on an agenda just to catch people and you don't really want to teach. Well, that's not true either, because if that was the case, I would just go right back to just the midweek review and the weekend commentary, and that's it, because that's what you signed up for. The daily log entries are training you and your eye to see these things. Focusing on those things that I show you in the daily log entry are important because it helps you frame what to anticipate in the coming session or sessions. It doesn't mean or limit it that it will only create opportunities at those levels, but that's primarily what I'm anticipating before the next trading day begins. You wanted to learn how I view the marketplace. You want to learn how I look for setups before they form. Anticipatory skills. This is how I developed mine. This is how you're going to develop yours. There is no shortcut. There is no magic bullet process. There is no easier way around it. This is the part that everyone that quits taps out at. They hate this part. And I'm only going to remind you that this is the requirement to get good at this. There is no video. There is no teaching that shortens it, makes it easier for you to get through. All of you are going to go through it, and it's a growing pain. If it feels like a hurdle or a barrier, like a brick wall in front of you, like I can't learn unless I have you tell me, that's not true. That is absolutely not true. Because if you see things repeating over a period of time, your subconscious is retaining it. You don't realize it, but that's what's happening. And you won't really experience it until you see more examples of it. And you'll say, oh yeah, I saw that in my own chart. And it's in my chart when he posted his. That's how you know you're moving in the right direction. But it's important for you not to think, I don't have that right now, so therefore I'm failing, spinning my wheels, I'm not getting anywhere. Because what you're having, without realizing it, is a unmeasurable experience level. And what do I mean by that? It's kind of like when you're losing weight, and if you get on the scale says you haven't lost anything, but you know those pair of pants that you had on last week fit a whole lot nicer now. That is a reward or a threshold that's unscalable. In other words, you can't see the effects in your progress on the scale, but you know you're changing for the better. You're losing weight. It may not reflect in the scale when you stand on it, but your clothing indicates that it doesn't fit as snugly as it used to. Okay, it's a little bit more give in your waistline. Maybe not all of you will draw a similarity to that, but nonetheless, that's what these daily log entries are going to do. Sometimes it's going to feel like you're not making any progress, but you are. If you're studying them and then looking at it in your charts, carrying over those annotations that I'm sharing with you into your own chart and adding any additional things or observations that you see. And by doing that, what's going to happen is you don't see this coming, but this is what's going to happen. You're going to find your specific niche in the marketplace. You're going to find that little thing that makes your model, the initial framework. It might be as easy as the optimal trade entry. It might be an institutional order flow entry drill running to a objective or a liquidity pool. All those things are going to materialize over time. If we were in a room, a group setting, you'd all be raising your hand trying to say, okay, how long is it going to take? What is reasonable? What's the amount of time frame for me to get what it is I'm supposed to be getting out of these price action logs? If you put a deadline on it, you're never going to get to it. I'm going to say that again. If you put a deadline on you learning something, you'll never get it because you're worried about not getting it fast enough. When your focus should be, I need to be applying myself consistently the same way each day, and then letting time and experience develop on its own timing. You can't speed it along. I can't do it because believe me, I simply would love to finish this mentorship earlier than what I got ahead. It's a lot of stuff, but you're all going to hit a brick wall when I hit you with new content because you can't even weather this little growing pain. So I could sit here and tell you all the bad things by thinking like that, but I want you to focus on the positive things by doing it. Okay? Because you'll know how you feel right now versus how you feel 3 months from now. You'll be able to compare and contrast. But right now, you can't see things the way you'll see them 3 months from now because you don't have that experience. You don't have that chart time in your back testing and in your studying. So that perception that you'll have in the future, 3 months, 6 months, 9 months, whatever it is, that will be a result of you doing these things, and you don't fully need to know what it is that you're going to find by doing it because it materializes in its own way and manner. And what I mean by that is if I took 100 of you and put you all in a private group in a room. And this is what I'm going to teach. I'm going to teach this, that, and something else. All of you, if you were forced to study over a period of months or so, you're going to come to the conclusion that isn't always going to agree with everyone's perspective at the end of that trial run or laboratory experiment. You're all going to have slightly different models at the end. Even though you may be operating in the same framework. And what do I mean by framework? Well, if you look at the dollar index, the last time we spoke, I said that I'm going to side with the idea that this is going to move lower and attack these lows down here. I think that's what's going to happen, and higher prices on foreign currency, euro and cable. Using that idea, each day you would go in and primarily focus on things that would be a short sell, okay, going short or being bearish. Dollar, but not that we're trading the dollar index, but we're looking for lower prices, and obviously the opposite would be seen in euro being higher prices, and in higher prices in pound versus dollar. In fact, all foreign currency going higher until we get to this level here. And then that becomes a point of decision where we have to determine, does it warrant further erosion on the downside, or does it warrant the likelihood of retracing higher up into whatever price swing is in place once it trades to this level or below it. So that's framework. So while I'm teaching that comprehensively to all of you, inside of that framework of being bearish up here down to this level here, you all will have slightly different ideas about how you're going to engage and look for shorting opportunities. And some of you will miss moves because the pattern that you're looking for, or that you adopt as your own and say, this is what my model is going to be. If that model doesn't communicate a setup in here, that doesn't mean that you have a flawed model. See, some of you are wanting the catch-all, okay? The silver bullet model, when that's really a result of watching me do many examples and executions and being able to trade both directions in the same daily range. That to me is not realistic, and it's going to take you a long time to ever even consider being able to do that. If that's what you're measuring as success, then that's a misplaced perspective, and your expectations are misaligned, because you don't need to have that. What I'm trying to teach you and communicate in this mentorship is, we were up here and I said, I believe that we're going to draw down into this level here. So what does that mean for the dollar? It means that it's bearish in my eyes. Doesn't mean I'm right. It just means that that's what I'm expecting. So when I do that, I want you to take that idea and go into the daily log entries and study that with that framework in mind, that we're looking for lower prices on dollar. Obviously, the opposite would be seen for higher prices in euro, higher prices in pound. So your pattern or model might not communicate a setup in here, and it might trade down to this level here, and you might not get as many opportunities as someone else in the mentorship that would have used a different approach to engaging in this price swing. It doesn't mean that their model is better. It doesn't mean that yours is inferior. It doesn't mean that they're a better trader. It doesn't mean that you're a lesser trader than them. It just means that you have submitted your faith and all of your energy in that particular model. Your model will give you setups, but some of you want to have the every setup model, and that is impractical. That's the thing that I made a terrible error in my first 6 years. When I would get something under my belt that I figured, well, this is useful, I wanted it to work every day, in every market, in every direction that I was trying to trade it in. I was trying to form fit it and push it and use my will over the marketplace versus, okay, this is the framework I'm looking for. Framework is bearish. I want to go short. So what model am I going to use? Well, if I like premium fair value gaps, okay, I want to see that as my entry, and therefore I'll trade that inside of kill zones, London and or New York, and I'll hold 50% and take 50% off after I get, 15, 20 pips, and then hold the rest until I get down to these levels here. Okay, that's a model. Did you need a whole video for me to do that? No. But some of you that are so new would prefer me having a video explaining all of that, but it's not required because I have enough foundational studies even in YouTube before you came to the mentorship. And then in the mentorship, I have even further studies that are made available to you in the core content that help you understand how to plug and play those ideas. But the mentorship is me giving you my framework. And I don't need to do that every single day. And you should not expect it every single day. You should be saying, okay, the last time Michael talked, he said that we're expecting weaker prices on dollar. Okay, wonderful. That means I'm going to focus on longs on euro, longs on cable. And I'm okay if I get stopped out. I'm still going to stay with that narrative until we change gears. Am I changing gears today? No. I still think that this is likely to be a draw on liquidity. If it goes through that, we have the volume imbalance down here, and we have the order block. So right now, this is the only level that I think is salient right now. That's all you need. You don't need anything else. You have all the context in here with this previous fair value gap. We traded down, back up in, spent several times and days in here, accumulating more short positions, and then trades lower. Now, when I say that, it's not saying they're accumulating short positions that push prices lower. That's not what goes on here. The algorithm is holding in this area, does not release price to the downside until a specific amount of time. Do the bank traders or interbank traders know how long the algorithm is going to hold price in the level? No, they do not. So that's why I say that they can miss moves. The algorithm is holding in here. Sometimes that is a manual override where they get manual intervention, where they physically, a man or a woman, go in and they keep price in this pattern and doesn't break out of a predetermined range. And otherwise, it's a artificial intelligence that's holding that price. So it's not something that is needed for you to know. You just know that there's a difference between certain characteristics in price, and you don't need to know how they work. Just like when you get in your car, you don't really understand how that engine works. You just know when you push the button or turn the key, it usually, if everything's working properly, starts right up. You also know that if it doesn't start up, there's a problem. Do you know how to fix the problem? No. But you know how to get it fixed. Well, the same thing here. Don't try to have everything at your disposal, because you're going to have too many moving parts to focus on versus having just one thing to focus on. One pattern. You need to know a bias. Are you going to be bullish or bearish? I give you that, and I give it to you in the commentaries. It doesn't change day to day. Remember that. So some of you that are sending emails to me are going against what I'm saying in the commentaries, and you're frustrated because your results aren't what you expected to be. And I'm frustrated because I'm trying to figure out why you're trying to go against what I'm showing you is the bias. And I get folks asking, can you go over more about daily bias? I've been doing that. That's the whole purpose of the mentorship, is for you to borrow my experience while you gain more experience in your own with learning the concepts, working with it in live market environments. You're not going to have me sitting down with you every single day, folks, holding your hand and say, buy here, sell. That's not what's going to happen. That's never going to happen. I didn't say that was going to happen. And a lot of you want to sweet talk me into thinking that's going to be a good thing for you specifically. And it's not. I've done that before, and it doesn't work. The only thing it does is make you want to be around me for that only. And you don't grow in your own independence. And that's essential for you to be a profitable trader. To have consistency and trust in your own analysis. Over time, you're going to know what directional bias I'm saying, or will say in the commentaries. But until then, trust what I'm showing you and telling you, and operate in that. That's how you go through this mentorship. That's how you work through the content. That's how you use the daily log entries. That's how you practice. That's how you back test. Everything. Some of you want to arm wrestle because you want to be a contrarian. I've had, in 2016, the very first group, I had a lot of folks still, and in fact, some of them still are, and they won't listen because I'm telling them to stop trying to arm wrestle what I'm saying is going to happen. Just go along with it and study in that context. And if they would, everything would click for them in time, a lot shorter time than what they're doing. And it's unbelievably frustrating, because if I give you the solution, it's not a quick, immediate fix, but the solution that you're looking for is in what I'm teaching you. But you aren't fully submitting to it. You're not giving yourself the time required that you yourself require. There is no uniform time. There's no specific, this is the optimal level of time required to get to this level of understanding. That's impractical. It's unrealistic. And I don't ever do that. And no mentor could ever do that. I don't know what you're thinking about when you're studying, or if you're even focusing. And while many of you are extremely focused and you're dialed in based on what I'm teaching, and you are wonderfully amused by the results you're getting, and I love reading those emails, I'm not saying that you're better than the folks that are struggling. And I'm not saying the folks that are struggling are any less of a student than those that are following my instructions. I'm just saying, as kindly as I can and as sincerely and as gently as I possibly can, so that way I don't offend you or make you mad or put you off as a teacher, okay? But you pay me to teach you. So I'm giving you my best advice. Some of you don't want to listen to the advice. You want to do your own thing and then email me and say that you're not getting what you thought you were getting and can't understand why the market keeps going the opposite direction, when I didn't say the market was going to go the direction that you're operating in or practicing in. So it's hard, folks. It's really hard to manage so many personalities and people from different cultures. And it's very hard to do this. Okay. And the only way you're going to be able to do this efficiently is listen and only do the things I tell you to do, and don't do the things I tell you not to do. If you all try to do that and practice and go through your daily progress through this mentorship like that, you're going to get here. But you're not all going to get here at the same time, regardless of when you started or how long you've been doing it. But with all that said, just know that in this framework, okay, when I say framework, that is, I'm bullish or bearish until what level? It doesn't mean I'm stopping my bearish stance once we get below here. It just means once we get here, then I'm going to reevaluate what the market has done, because we don't have all the candles in place. It might just create a big down candle tomorrow, and that gives me something to consider. Or it might trade back up into, maybe bump the bottom of this bullish candle, which is a bearish order block, and then trade lower. Or it may not even go down there. So we have to, number one, submit to the framework that it's most likely going to occur, but there's always a potential for me and you to get it wrong. And you have to adapt. Take the loss if you have a loss. Accept the fact that you missed the opportunities, if you missed any in here, and just work with that going forward. And that experience will serve you well. But framework is bearish until we get here. Your models may or may not have a setup in here. And if it doesn't, as a reminder, don't abandon the model simply because you didn't get a setup when you were hoping to. Because that's usually what I was doing in the beginning, where I would have something that really worked, but because it didn't give me a setup 2 days in a row, let me go back to stochastics divergence. And then I would lose money because I was impatient. I wanted things my way on my timing, and the market's not going to deliver that. You have to align yourself with it. And that's a really hard lesson to learn or communicate. You can say all the things you want to say about market psychology and all the books like Trading in the Zone. All that stuff. It's a good book, but the best way of learning market psychology is to go through what I'm putting you through. You have to submit to a lot of time. You have to submit to processes that don't feel comfortable. They feel like they're counterproductive. And that's why most people can't do it. Because it's changing your thought process. It's rewiring your expectations and removing entitlement. You want it right now, and you don't want to have any pain going through it. And that's exactly what I wanted in the beginning. But over many years and scars, realizing that, hey, look, I don't always get it right, but even when I don't get it right, I'm still right more than I'm wrong. And if I can manage my money correctly, I'll be fine. And the same thing for you. So back into this chart, and we'll get on with this commentary and lesson. I just want to give you that because it was, in my mind, required. Fair value gap in here, we traded down through it, and then it acted as an inversion level where everything here that would have potentially offered some bullishness, once it trades through it, then it acts like what? The ideal support and resistance idea. While there isn't a support or resistance level in here, the fair value gap operates just like support and resistance is spoken of in books and courses and such. So it accumulates more short positions in here and then reprices lower. Focus on this low in here. If we sweep that, it can dig as far as the volume imbalance and bullish order block. If we break below this down close candle or bullish order block, we'll be looking for this volume imbalance down here. Okay. If not the short-term sell-side liquidity pool here, that might be an area where it might get a reaction. If it just goes straight on in like that, then I would expect a reaction rate below here because that would be sell stops being tagged. But we have a larger pool of liquidity right here because we have two levels, and retail sees that as support. So, you know, if they're thinking that is support, a lot of other traders are thinking if it goes down here, I'll buy that again. And where they're going to put their stop loss? Just below it. Where would be a beautiful run for IPTA if that's the case. Fill in this volume imbalance, trade back to the order block. Okay. So with this framework in mind here, we're going to drop down into the hourly chart. See that? You never thought we'd get here. All right, here's the dollar index 60-minute chart or 1 hour chart. You can see how we spent the majority of the time in here. Look at the bodies of the candles. We only had two candles, or really this candle here, that only opened outside of that range of that old daily fair value gap. And then look what happened. Heavy distribution. Trades up here. Heavy distribution. This is not, a lot of sellers came in the marketplace and pushed price down. And a lot more buyers came in and pushed price up. And a lot more sellers came in and drove price lower. And then more buyers came in and drove price up. And then short sellers drove price down, and they came back up one more time because there was an arm wrestling match between buyers and sellers. And then the sellers came in and took control. That's what you're taught in books. That's not what's occurring. The algorithm is holding price in between the two levels I've given you on that daily chart. And you can see that with the bodies. Okay, all this consolidation is occurring and holding it for interbank traders that are looking for these types of things to get short. And then heavy distribution after our stop run, and then bang, runs lower. Template. All right, dropping down to the 15-minute time frame, you can see that fair value gap from the daily up here. And we drove down, took out sell side liquidity from over here. And just a heaviness in the marketplace. Now, when I say the market's heavy, this is what I'm referring to here, this type of price action, where it isn't coming back up, with the exception of only this move here. It just stays heavy and just keeps on going lower. No real intermediate term or short term bounces higher. The algorithm is just pricing it lower, 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 lower. Then we consolidate. Do we really rally up? No, it only goes up to a fair value gap there. See that? Comes in, offers what? Interbank traders to go short. What's going to attack? The sell side liquidity resting below these lows. So selling here, attacking here, and staying in sync with what the higher time frame order flow is, which is that old area of sell side liquidity I mentioned multiple times in this video and prior to this video. Basically where I'm framing everything for dollar to go to on a bearish stance. And the market trades aggressively in here. Not all that aggressively, but compared to all this, it's aggressive. And right there is the chairman, Fed chairman, speaking here and hasn't really done much. So if you haven't already noticed, the economic calendar has really not been blistering, if you will, with a lot of information or news drivers. That coupled with where we are on the daily chart, there isn't a whole lot of excitement, which is why I'm saying there's probably going to be an event of some kind to get things all stirred up in the marketplace. So right now, again, everything's pouring into equities and in crypto. And by the way, Bitcoin hit my 62,000 target. I have absolutely no idea what it's going to do. Please don't ask me an email. I don't know. I don't know what it's going to do. I don't know what it's going to do later on if it makes changes in its daily chart or hourly chart? I don't know. And I really want to go back to not being asked because I don't know. Okay. And you're just going to get frustrated with me saying that again. I don't know. But I think that's going to be it for dollar. We still have a little ways to go on the downside for it. So let's go over the euro. All right, so here's the euro dollar daily chart. And we have a breaker here. So we have the high, low, higher high. This entire range is what's shaded in here. And I mentioned if we were going to see that lower run on dollar, we would likely see this area here swept for buy side liquidity on euro dollar. And you can see we just fell short of it here today, and we'll look at it when we drop into lower time frames. But I want you to also notice that this sell side imbalance, buy side inefficiency, which exists inside of the breaker, which also is just above for the buy side liquidity here. So we have consequent encroachment there. And also we have mean threshold of the breaker. So a lot of that is just above this level. I feel that that's likely to basically be delivered. And we were talking about that in here where it could reach up to, and it's been happening. So that's the framework for euro. I'm still bullish on euro. And let's take a look at these candles here on an hourly chart. All right, so here's the hourly chart, and I have the opening price on the last 3 days, so that way you can see the power 3 concept that I teach. This is the accumulation and distribution pattern that I internalize when I'm looking at price action. So here's the 12th. This is on Monday. The opening price at midnight, right here. That opening price is 118.92 and 6 pipettes, and the market drops down for rejection block. Price rallies again, but notice, does it take out this high here? No. So there's liquidity that's pulling above here. The market drops down once more. Here is the midnight candle. The opening price is here, and the market drops down here in New York, taking out the London low, and then accumulates and rallies. This was from yesterday, and I was in this move here. But the main takeaway I want you to see is when we're bearish on dollar, and I gave you that framework relative to its daily chart, we're bullish euro. How do you operate in that? You find the opening price at midnight on the candle at the 60-minute chart. Okay, get the opening price and draw that out to noon. Okay, just if you have that on your chart like that each day, and study how the market trades immediately at and after midnight at the open New York time. If you're bullish, you want to see it trade below that, which it does here. The lowest low of the day forms right here on this candle, which is 4 o'clock in the morning New York time. That's London open. So from here, and as we trade down, anywhere in there, you want to be looking for longs. And you want to frame that based on this over here. All this market structure here, you want to look inside down on lower time frames and find things that you can frame the trade on and get long on. And the market runs through, leaves this level here, so you know when we're consolidating and it drops down, all it's doing is reloading to run through this level here. And it does here. Here's the opening. Even though we have an initial run up, it drops back down in New York for a New York reversal profile, trades back into the order block, clears sell side liquidity, optimal trade entry, rally aggressive, takes the buy side liquidity out, and then what happens? The same thing we saw just in a mirror image on dollar, it just steadily reprices higher. What is it reaching for? Well, this is that area on the daily chart, which is the bearish breaker. It's the beginning of that shaded area. This whole shaded area up here, that's that bearish breaker. This is the level that's just above those relative equal highs on the daily chart. So it's just underneath that. But notice how, again, once it clears these highs here, the algorithm goes right into just a steady delivery of price. There's nothing offered as a short. It's just steady going up, 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 up. And it has very shallow retracements. So it feels like it doesn't give you any buying opportunity. This is a market condition that is going to frustrate you if you don't know how to anticipate it or look for it or why it's doing it. And it's also one of those times where you just sit back and say, okay, I can't get a position on, so leave it alone. Don't force it. Don't arm wrestle it. Don't say it has to come back down to this order block or it has to come back down to this order block. Nothing has to do anything, but it's drawing up into this level here because that's where the liquidity is. So the algorithm is not retracing deep enough because it gave interbank traders lots of opportunities all through here to accumulate longs, and they're waiting to see if we can get above this high here, and they will offset distribute their longs there to waiting buyers in the form of buy stops. Again, same here. Opening on this candle, extend that out in time. When it trades down below that after midnight, so it's after midnight, that's the time element, time and price. What's the price? It has to be at or below that level. So here is the New York open, and this is also an optimal trade entry here. Low to high, drops back down in, below the opening price. There you go. For some of you, this is all that's required for a model. You know your framework, bearish dollar, higher euro. Find your opening price at midnight. Buy it at or just below the opening price. And just hold it. Hold it until we get to the afternoon in New York time and unload it above some old high. That in itself, that is a complete model. I'll say it again. If your framework is bearish dollar, that means you're bullish on euro. Mark out the opening price at midnight on an hourly chart. At that price or below it, in a kill zone, you want to be buying it. Then get out in the afternoon. That means anywhere between 11 o'clock in the morning to 1 o'clock in the afternoon, New York local time. And if you can be there above an old high, you have time and price meeting. So there's your exit strategy. How much money should you risk? 0.5%, 1%, nothing more. How many trading days did you have that were favorable with that? With that framework I've given you, with bearish dollar, higher prices in euro and cable, you can buy here near the low of the day. You can buy here near the low of the day. You can buy here near the low of the day. It doesn't need to be complicated, but you signed up for all the freaky insights, all the things that nobody else would ever learn. That's why you're here. That's what I'm teaching you. But I'm also teaching you how to trust almost 30 years of experience in knowing what the market's likely to do next. Don't arm wrestle me. Just try to get yourself in alignment with what I'm teaching you and direction, what I'm looking for and pointing to. They aren't changing day to day. The daily bias isn't daily bullish, daily bearish. Daily bullish, daily bullish, daily bearish. It's not that. Some of you think that's what this is. When I'm saying I'm bullish euro, I'm bearish dollar, and it's going to stay that way for a couple days, if not a week or more. So remember, the hallmark to this mentorship is we're trying to trade inside of the weekly range, and we're forecasting. I'm teaching you how to forecast the expansion of the weekly range. In other words, the candle that makes up a weekly chart candle for the week, wherever we are, like right now, this weekly range, the likelihood of the weekly range expanding on the upside for cable and euro is highly probable because the weekly range that's likely to expand on the downside for the dollar. Okay, so that framework, that mindset is how I want you to go into each individual day. But now, because we're trading very close to that buy side liquidity pool, any longs at this point now become less probable because we've already got real close to it, and it could ultimately fail. What? Fail? Did I say fail? Yeah. You have to know when the probabilities fall out of favor. And right now, we're really at a premium. Do you want to be buying up there? No. So if you haven't already, you missed it. Now, that's a sticking point for some of you. You're going to be angry. You're going to be upset. You're going to be frustrated. Oh, I got to get something now because I've been watching this thing for days and I didn't get a treat. Yep. That's life. And that's the lifestyle of a trader. You're not going to catch them all. This ain't Pokemon. Okay? You can't try to get every single one of them because you're going to lose if you try to do that. And chances are you're going to be forcing something that's less probable than another setup that if you just would have relaxed, you probably would have noticed it and you'll miss that one. And then it just creates this loser cycle in your mind that you constantly will wrestle with. And you can't really appreciate it until you endure it at least once. Usually it's the second or third time you go through it, you're like, oh yeah, I know what this is. You got to stop. The way you remedy it is take a break. Don't look at charts for a couple days. And if it's really bad, and if you hurt yourself in a live account, which is what you shouldn't be doing, take a week off. Don't look at my videos. Don't look at the charts. Don't look at social media. Just relax and ground yourself, and then come back the following week fresh. I promise you, when you do that, it just gives you a different outlook, and you're not pressuring yourself. Well, anyway, Power 3, accumulation below the opening price relative to the opening price in New York midnight. And there you go. Power 3 is buying near the low of the day and riding the expansion on the upside. Buying the low of the day and riding the expansion on the upside. And you keep doing this each day. Now, eventually, you're going to get a day where you try to do that and it stops you out. Does that mean throw the whole model out and change your framework? No. It just means that the next day or the day after is probably going to be a really good buying day because you had a down day or a retracement day. That's what creates order blocks. That's essential. That's something that you want to see in price. You really don't want to see, until we get like where we are now, close to a target, where you want to see just the up candles only and big candles on upside. Whereas in between, where from here and here, down close candles are okay. You want to kind of see that. It's building in order flow, because the down close candles will eventually be used at a later time, much like this one here did, where we traded down into Power 3, which is the opening price and below at an order block, then it rallies up. Okay, this is a really small range, which is also another reason why, because of the volatility that we've entered, it's really small. And I've been harping on, even in my Telegram room, that small 10 pip ranges are going to serve you if you practice in that, because you can find them in this. You don't need to have the 75 pip or 50 pip runs, because the market isn't likely to deliver that on a day-by-day basis in this current environment. It's very, very consolidated. It's very small ranges, which is good, because that means there's going to be something, and I don't know what the something's going to be, okay, that creates this expansion and volatility where the daily ranges get really big again. So we're in a quiet period. When we start getting into big ranges, then it'll become easy again, where we have big ranges, big opportunity, and it just becomes much easier to trade. But when you hear me say things like that, especially if you're new, it's like, oh, you're just making excuses. Well, I don't need to make any excuses. I'm telling you where the market's going to go, and the market's going there. I've taught you how to get in and engage it, and it's offering those opportunities as well. It's not giving you a whole lot of the things that I teach in this area here, because it's a different state of delivery, where it's a steady drifting higher up into a pool of liquidity. And this high here will be higher on other brokers and not necessarily what you see here. That's permitted. That's reasonable. Okay, when you fill your paperwork out to open up an account, you're basically giving them permission to be able to say, we're not going to open the spread that high, or we're going to open the spread wider, and it's going to be at their discretion. But it isn't going to be 10 and 15, 20 pips. It's going to be within reason. But just know that we have seen what we were expecting in terms of delivery. We still have a little bit more to go, and we'll most likely get there to the 120 big figure. But really, we only need to trade to 119.91, and it's accomplished what I was looking for. All right, here's the 15-minute time frame, and the market trades down. Here's that opening price. Accumulates once more here in New York and rallies up, and we're just falling short of that relative equal high on the daily chart. And really nothing more to speak of in here. I'll just give you a pan back here for the opening price. Due to swing lower, buy it, run. Opening price, not chasing it higher, trades below it, rallies. Now, here's the thing. You could have been a buyer here and then got stopped out here. If you get stopped out down here, in other words, if it runs down, hits your stop, you can put a buy stop to get you long right above the short-term high. That's one of the things I like to do if I get caught up on the wrong side, and maybe my London Open setup that maybe I'm long, or maybe I'm long from the previous day and I trusted the London Open's low, and it comes down and hits my stop that I put just below here. If it does that and it runs my stop, I can put a short-term entry for the day only. It's like a good till cancel order only for that day. It's not an order that I leave in, for forever. It's only for that day. Where if it trades back up, then I'll be caught long, and then I'll use the low that has the stop run as my stop loss. But I'll leave the order in as a buy stop with no stop on until it engages. Once it goes in and trips me in long, then I price in the stop, because I don't know how far this will go down. So when you watch it go down like that, if it stops me out of my long, I don't get upset. I don't get mad about it. I say, okay, well, it's a stop run, and I can just go in here and put a buy stop order at the swing high and let it sit there. And if it comes back up and fills it, chances are it's what I think it is. It's stopped me out. I put my stop in the wrong place, and I made the error as a human. What? Come on, Michael. We're not supposed to be making errors around here. No, I'm teaching you practically. This is what you're going to endure. You're going to have that happen to you. It happens to me. So when it does happen, what do? What's one of the ways I can get back in sync with the marketplace, but not try to catch falling daggers? Because the market could keep on going down. If it does, my buy stop never gets tripped, and this is a missed opportunity. But if it does go down here, it stops me out. Once that stop out occurs, then and only then do I put a buy stop in to go long on buying strength. That's the only time I personally feel comfortable with using a buy stop to get in long. Otherwise, I'm using a limit order to buy as it's going down, or I'm going into market as it goes into an imbalance and it's hitting a level I'm looking for, or an order block. But predominantly it's a limit order. But buy stops entering on longs, that is the criteria I use. So right there's a lesson for you. That lesson alone is worth the whole admission price of this month. So that's why it's important when you're watching news events or the opening session in New York, if it goes down and runs the London low out, but you're bullish and it does stop you out, immediately put the buy stop right here and leave it open with no stop loss, because you have to put the stop loss in after it has turned. And then you can look in here and say, okay, well, if we have the opening price on this candle and trades down here and starts to run back up and hits it, you can put the consequent encroachment, which is the midpoint of the opening price down to the low. You can find that and then go 2 or 3 pips below that and use that for your stop. It doesn't necessarily mean it needs to go all the way below here. Or you can go right back to the point of where it ran the stops. So this dropped down. Well, what did it run? It ran this low. So you can put your stop loss 1 pip below that low because it's already done its work. It should not go back down there again. If it does, it's probably going to keep on going, and you want to be out. Now, I said a lot in the last 3 to 5 minutes. Rewind the video and listen to it again, because I just gave you gold. All right, here's the British pound versus the US dollar. It's our daily chart. And this one here is really consolidating, and it's got a couple different things it can do. So admittedly, before I go into this, I don't know. Okay, I know I like to draw a line and say I'm bullish to this or I'm bearish to that. I'm just going to use my own prerogative here and just tell you I don't know. Okay, I don't know what this pair is going to do. I'd like to see it go higher, but it might squirrel around and just go sideways. So that's the reason why I don't want to touch this one. Okay, I did some in the last 2 days. I did some trading in cable. I did some trading in dollar CAD. I did some trading in euro dollar, and I did some trading in S&P 500. So those are the markets I worked with over the last few days. Cable, as it is right now, we do have the bearish order block here that it could trade up into. So from the low to the opening price, watch these levels here. If we trade through that rather bullishly, I think we'll go through the mean threshold of this last up close candle. And if it does, then we're attacking the buy side here. I really like the idea of it potentially running up here, especially if we were weaker on the dollar. Cable would most likely draw up into here and rebalance all of this. It can stay sideways, and it can stay sideways more likely than that of going higher based on what we're looking at here. And or it could just go lower while euro consolidates and dollar consolidates. It could go down and take these stops out here, and that could be also something that occurs and sends euro pound higher. But there's so many different things that could happen with this, and it sounds like a retail trader talking to you right now, but I want you to remember, I've stated before, High probability, as I define it, okay, the inner circle trader definition of high probability is how you can frame the market on one side only, and it's a hard sell to be the opposing view. Right now, I could argue both sides of the marketplace here. I don't have that with dollar, and I don't have that with euro. So if dollar is likely to go lower and euro is likely to go higher, then by default, this should be a weaker currency, but it's in a bigger range here, and it seems like it doesn't want to do anything. So that's one of the factors I have when I don't want to be trading a market or hold for like a one shot, one kill, 50 to 75 pip type run. I kind of like go through a checks and balance type thing, and when the market, like this pair here, is offering potentially both directions, like we have a small little fair value gap in here. Notice how it filled it? It could sell off from there and go down below these lows. Or it could ignore this, trade above it, comes back down in, find support between this low and this high, and then send it to this buy sell liquidity. Now, that's 50-50. That's what everybody on YouTube, everybody on Twitter, okay, or Instagram, and they say, which one do you think is going to happen? And they give you a scenario A and scenario B, and whenever one happens, they come back later on and say, look at what we did, we called that. Well, I'm telling you up front, I don't know what this is going to do, because it could do either one of them. And because I can't cancel out one side and favor one over the other, in other words, I can't say I'm bullish cable from where we are right now, and there's no way I can see selling or shorting. I can't say that. Because I can't say that, that means it's not high probability. I think it's high probability for euro dollar to go higher. I think it's high probability that the dollar is going to go lower. But cable, in its current state, with its market structure as it is, it's at a crossroads where either way it could happen higher or lower. And the way you determine that is what I just outlined here in another lessons where I've talked about it. It means it's less probable, and it means lower probability and not high probability. So bear that in mind. I won't be touching cable, for the remainder of this week, but I could do something with euro if we go above those relative equal highs on the daily chart and then break down and create an imbalance. Then I'll test a TGIF setup to go short on euro on Friday, something like that. But I'm not suggesting that right now because it hasn't obviously traded on Thursday, and we don't know what the market's going to do 2 days from now. Okay, we have to let the market produce its insight, and then we make a decision based on that. But I'm just giving you some basic scenarios of what I would like to do and what I would consider right now without having anything in the charts to really warrant a decision to do anything at the moment. But I don't see anything in here on cable. So hopefully you can understand that there's a strong contrast to when I say I don't know what I'm looking for in here, and I don't think the market's going to do it. It doesn't mean an inability as a trader, I should know better. No, I know enough to know that this pair is offering both sides. So do you want to be trading in a market that is potentially 50-50? Or do you want to trade in a pair that has more probability that it's going to deliver one-sided and not going to be back and forth, where this one absolutely can be? So hopefully that's made a little sense to you. If not, I promise in the future you'll see things in the marketplace and experience things, and this lesson will be more meaningful to you. If not, the notes that you've taken from this video. All right, here's the hourly chart on cable, and you can see that we could potentially trade up into these levels here and the buy sell liquidity up there. Relative equal highs right in here, and a small little remainder of the fair value gap there with a bearish order block. So there's a lot of liquidity in here. I like that getting there. And I'm going to add the opening prices at midnight so you can see and study the power 3. And the opening prices, let's zoom in here a little bit. So here's the opening price here. And we drop down, create the low of the day, rally. The next day here we open, trade below the opening price here, New York setup, optimal trade entry, rallies. Same thing here, opening price, we're not considering chasing price on the higher side. If it drops down below the opening price, if we match up with some kind of a discount array over here, then obviously that's a potential setup. Accumulates longs in here at the New York setup, rallies. Doesn't really get above here. It might be accumulating to send it higher later on, but it should not, if it's good, should not go below this low. If it does, then the conditions I outlined before we dropped into the hourly chart for cable are likely to continue, where it's uncertain and consolidation is the expectation. Translation, low probability. All right, here's 15-minute time frame. You can see the Judas swing here. Below the opening price, rallies. Same thing here, opening price, draw that out in time. Trades back down right into this fair value gap in the form of a buy side imbalance, sell side inefficiency. You saw that in your daily log entry, and the market rallies up. Trades back down into small little fair value gap and order block here, rallies. Bearish order block, it's holding it in there, but I'd like to see it, if it can come back down in, just trade below here. Don't completely close it in. Trade down below that and then send it higher. That's what I would do if I was making the market for cable. But what I'd like to do and what it does is two different things, obviously. But that's going to be it for today. I gave you a lot of things and a lot of approaches and things that I would do when I would do it, how I would do it. If I get stopped out, how do I use buy stops? That's what I taught you today. And what conditions I would use to warrant a buy stop entry for longs. And obviously everything I said in that example, if you reverse it, in other words, if I was short and I took a stop loss and trailed it down to a high that's maybe a London high, and it runs up in New York and stops me out, as soon as it stops me out, I would put a sell stop at the low prior to that run on the stops. And I would leave it sitting there and wait for it to fill. I'd babysit it. And once it fills, then I would use the stop loss based on the stop run. And I would use either the previous high, which in this case would be like a London high, plus 1 pip. And that would be my stop loss. And I would let it, pan out. If it stops me out again, then whatever. I'm not going to be upset about it, but you don't need to be fearing getting stopped out of your trade, because right now you have analysis paralysis. If you get stopped out, like a deer in headlights, they don't know what to do. They just like, oh, look at that. And it's a semi truck coming right out at 55 miles an hour until it's too late and they're gone. When you get stopped out as a trader, if you're an experienced trader, the inexperienced trader has this fear of, what do I do now? I just got stopped out. Before the pain and the anger sets in, just uncertainty and fear sets in, and that causes paralysis. By knowing what you're looking for in the framework, you don't abandon that. You fell victim to a stop run. You put your stop loss in the wrong location. I do that too still today. It happens. But when it happens, you don't lose your mind over it. You just put a buy stop to go long if you got stopped out on your long. And once it runs and hits your stop, then you put your protective stop loss on that new long entry. No, it's not the best entry, but it's the peace of mind entry. Okay, that's what I named it. It's a peace of mind entry, knowing that I already seen the stop run. I fell victim to the stop run, but now I'm going to get in if the market runs in my favor in that directional bias again. Then I'll go back and put the stop loss below where it already ran, because it's not likely to go back down there. If it does, you're probably wrong and you want to be out. And everything just reverse that if you're going short. So until talk to you on this weekend's video for the remainder of the week, be safe.